None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Always good to start another week, right?
That's right.
Yeah, we're not a lot going on. We're seeing a little rebound in the market, but there's absolutely zero news. There's nothing out there at all. We were struggling trying to find something. We failed. We couldn't find anything. So, but we'll talk about all the details from a VPM standpoint here shortly. We're going to do our typical show that we always do. We've got the review of the indices, and we'll talk about interest rates a bit, see if there's anything going on in currencies or crude oil and all that kind of fun stuff that could affect the markets. Geopolitical news, everything's on page 22 now. It doesn't look like, well, there's a whole bunch of stuff going on. It doesn't appear that anybody's paying attention. They always say if it's not happening in your backyard, then it's not happening, right? So, but anyway, nothing really going on. We're seeing some rebound in the market, as I talked about a bit ago. So we're going to go over that. Mitch, did you see anything else out there that we should bring up initially?
Not really. I mean, it's boring out there. There's no earnings, or there's earnings is tailing off this week. And as far as the economic calendar, there's nothing today, and there's a few piddly reports throughout this week. Not even that much that would sway that I would see.
Maybe those of you that might not be music buffs, that's Summertime Blues, the song that we start with, at least for right now. We usually have some other stuff that we'll bring up, but the bottom line is it's pretty boring again. We're seeing a number of things that are gyrating around, but nothing really happening here. So I guess we'll go ahead live with the charts and get into the show here, and we'll start looking at the S&P 500 here. And one of the things that's happening is my mouse is not to be found anywhere. There we go. I think Mitch is trying to steal it from me. Maybe not. Anyway, so looking at the S&P, there's a couple numbers. We were able to, if you look at our daily range numbers that were in the commentary, there's two things that we do on Monday is we have the daily numbers and we also produce the weekly numbers, and we'll review both of those. But today, resistance 2 was 1942.45. It looks like we were 44.90. Yeah, 44.90 was the high for today. So we exceeded that by a little bit. We pulled back underneath that number now. I talked about this in commentary. This is a real key pivot number from the pattern, from the standpoint of if we are unable to close over this 40, actually the technical number is 1942.85 is the key number that we need to stay below on a closing basis. If we close above that, then we could see move up as high as 1952 to the 1958 level, and we'll talk about this. We'll go through some retracement values here shortly just to talk from a Fibonacci standpoint. But for the most part, we've seen the initial decline off the tops, and now we found support. If you recall, probably Wednesday or Thursday on commentary, I was talking about getting this little bounce in the market. Instead, we actually went down for another day or two and printed some lows. We printed all the way down to 1904, and then it then it bounced off of that on Friday, and we saw a pretty nice run. Actually, it was Thursday, and on Friday we saw a pretty nice run where the markets just kept grinding up, and then the last hour or so we saw some pretty good short covering. There wasn't anybody wanting to stay short over the weekend for any reason, so there's not a lot. What that tells you is not a lot of conviction in the markets right now, as far from what was going on last week. So we're seeing a lot of headline news move the markets around last week, and as the headlines dissipated, the markets rallied. And we'll go through the whole spectrum here. But one of the things that's really interesting, I think, from a momentum standpoint, and I'll bring up the graphic here, and the PPMs on this chart here are showing PPM. We're looking at PPM. We're looking at 1, 2, and 3. We're looking at 0.04 here on this, and then on the PPM 1, and PPM 2 is 0.23, and then PPM 3 is 0.23, and that is really the shortest term one. The PPM 1 is actually very flat, and we still have just under the trend mode. If you're kind of splitting hairs here, at 0.25 or greater is a trend. We're 0.23 on both of those indices, so we came down 2 and bounced off of those numbers the other day. So let me just bring up what we got to here, see if we can get to a couple of numbers real quick. But you can see we got down to 1916. That's the 21 period moving average. The other day that average was 1912, 1913, and we got just below that for a minute, and then we rebounded off of that. And the reason why we rebounded, we had some pretty decent momentum, yet it was still pushing above 0.25 at that time. So we're seeing a stabilization, and most likely what we're going to see here is some sort of sideways movement, whether it's 1 week, 3 weeks, not sure at the moment. We don't have enough of the pattern to read to really get a feel for that. We'll go to the shorter term charts here in a minute and just try to break this thing down. But for the most part, we're locked in a sideways range. We're not really going anywhere, and we'll talk about it in a minute like we usually do. We saw some further rotation out of the market from a VPM standpoint, and we'll talk about what that means in just a few minutes. But strictly from a technical standpoint on the S&P, pattern's broken down, but it hasn't signaled a downtrend yet. It's simply in a sideways range, and as the momentum bleeds off, we're likely to see further evidence of that. So let's go over and let's look at the daily graph here real quick. Daily graph, you'll see that we traded down below we were trading below the 10 period moving average, and it's starting, the momentum is still minus 0.24. And let me just get what that value is real quick here. That value right now is 1935.84. So with a 0.24, which is just below, minus 0.24, is just a tick below the trend level, we're likely to see that this thing will sell off and probably close below that level. We'll see if we can get a sell-off at the end of the day. Typically, you won't close above that number. You might spike above it intraday. So that's going to be a number to watch as we're coming to close. 1935.83 right now, and this is recalculated by the tick here. So let me get out of the way here for a second so we can look at some of these other numbers on this chart, make it a bit easier. You can see on the left-hand side now, you can see 0.24 minus 0.24, 0.8, and then the PPM3 is 0.0019, which is about as flat as a pancake. It's not really going to do much here at all. It's really just a flat average. What we could see, and so we look at the Fibonacci retracements here, and I'm just going to bring up a calculator here so we can get this. And just looking at, I know these numbers might be a little, depending on the size of screen you have, but we're looking at, we got up to almost a 50% retracement of the decline that we just had. So 1949.08 slash, we'll make it 10 rounded off. Then the next number is in 1958.64, which is that probably extreme number, which is the 60% line. You could go as high as 1960, and the ultimate extreme, the 66.6% level, is 1964.95. And remember, the old highs were 91 and change, so 1991. So typically what we'll get when a market breaks down is a rally back toward the what's called a right shoulder. So from a standpoint of what's going on the patterns, is that we'll get the initial decline, we'll get a rebound, we'll set up a right shoulder, and then that low will be retested at the 1904 level. And if you recall last week, we're talking about a range on the downside, initial shot on the downside would be around 1885 to 1865 level. That's still on the I guess on the dockets for right now. There's not anything that has negated that. Possibly if we were to get above that 1964.95 number that I talked about, so call it 1965 or better, then you would see maybe that pattern or the probabilities drop for that retest. But for as it is right now, there is a very strong, I would put it in the upper 60% range of a retest of the lows at 04, considering we don't get above the 65 level. And more importantly, if depending on how we act around this 1942.85 number I discussed just a minute ago, that will also determine, at least from a short-term trend, how this thing is likely to play out. As you would expect, we're one news story away from everything changing in a heartbeat. I think I guess it's been 2 weeks ago now, on that Thursday, when the final day of July, when the market broke down, it was, literally the last 2 hours we went from trading not too far from the high of the month to making new lows on the month and closing on the month, creating that reversal bar that I talked about. In fact, let's go ahead and take a look at the monthly graph, just so you can see the entire range here. And one of the things I continue to talk about is what the probabilities are and what the pattern that's going to unfold as this market starts to put in a top. We're currently 136, 147, and 1% on ppm 1, 2, and 3. And what that tells us is that the ppm 2 is advancing a little bit faster than the VPM 1, which is at 1.36. The bottom line is that's going to have to drop below 1% before we'll really start to see a high. And that value for the ppm 1 is tracking the 10-month moving average. That value right now for that average is 1880. So that if we did go down to 1880, certainly in the next week or two, this is a monthly number, these numbers aren't going to change much, and that's going to put us at right at support with a very robust trend. So that would tell us we probably don't decline much from there, and we would get what the ultimate pattern would be, is what I was just talking about a minute ago. We get the initial decline that we did down to the 1904, we get a rebound here, and then we get a move down to 1880, and that would be of a larger degree. That would be the first wave down. Then we'd set up a shoulder on the monthly graph, would be the next place to look for that reversal to continue, and it would be how we finish the month of August will probably tell us a lot about the rest of the year, I think. So we'll see how this all plays out at the moment. Right now, the long-term trends are still very much intact. And I'm going to go back to weekly for a minute. And one of the things that we release every week is the weekly ranges and the expectations. Resistance 1 is 1942 even, and so we've just exceeded that. 44.90 is the high today, and the next level is 53.65, and then 1965.30, which coincides with those Fibonacci numbers and expectations of that rebound. They all kind of cluster together, and those are one of the things that I've done in doing technical analysis. You always try to get a lot of things to cluster to tell you what the probabilities are, and the more valid processes that you have that are lining up will tell you the probabilities. At least it has for me for a lot of years. And so, yeah, it's hard to believe. I thought it was 34. I'm working on in September, in a month and a half, 35 years doing this, and been playing technician for about 33 of them, I guess. So let's go down, but those are the ranges. On the downside, S1 or the support 1 on a weekly is 1921.20, and then we're right into that 1909 and then 1897, 1887. So we'll see how it plays out. The last several weeks I was expecting, prior to the breakdown of 2 weeks ago, I was expecting S1 to hold and then see us go up to S2. So we've been to S1 or R1, and we're working on, maybe we're going to get to R2 on a weekly, but I think there's going to be some pretty serious resistance in these levels, and we're still seeing the 3-day range indicator, the volatility indicator, is at 2132. I know a lot of folks use the VIX. This is my internal volatility indicator, so we're still pushing 2132. I suspect with today's range we're going to see some contraction, or start to see this contract, and typically what will happen is we'll see market move up like this, volatility contracts, and maybe come back into to around 15, maybe even below 10 again, and then we'll get our next move up. So we could see this consolidation sideways range set up. So not a lot of excitement. I think most of the excitement that we're going to talk about today is actually in the BPM database and some of the things that we got going over there. Let's do one thing here, and let's take a look at a pretty short-term chart, and then we'll go to the futures, look at the treasuries, and then continue on with the overview. We can see that we're seeing some pretty good acceleration in this trend on the. This is a 60-minute chart just on the cash. We're seeing a pretty good acceleration here off of these lows, and everything's turned up. We got PPM 0.19, 0.05, and 0.02, and these numbers on an intraday, you have to move the decimal, so that's a pretty good move on for this market. So it's pretty robust. We probably see it top out. Possibly we've seen the high. We'll take a look at that in a minute. But this is what's going on the cash markets. Just before we move on to the shorter term charts here, this is the chart I've been talking about for a while. This is the EFA versus the S&P. We saw an uptick when the market was getting hit pretty hard. You can see it's down-ticked again, and this is so far a typical pattern. We'll see if we can get another uptick, and that would most likely happen when the next turn back down on the market happens. And so we're seeing the same thing. This is the EEM versus the S&P, same pattern. It upticked and now it's coming back in. So no real trend break from what we've seen over the past. So let's go over here to the futures, and there's a couple things that I was looking at. We had looked like a top cycle coming in, but but there was one more new high after that. This is a 5-minute 24-hour futures chart. So you can see this has been grinding up all night, just kind of working its way higher. So it's kind of what I call a creepy crawler, and there's not a lot of momentum in this at all. Well, we've seen a couple volume spikes during the night, but nothing to really talk about. On the hourly graph, I did see just recently there is a top, and typically when of these cycles come in, it's within an hour or two that we'll see a top. So we just had a cluster volume spike, not a real big one, come in, but we also had a cycle come in. So we're likely to probably fade this pattern a bit into the close. We'll see if we can. The two numbers I put out in the review just a minute ago was the 1942.85 and then that 35.90 number. 1935.90 is going to be the other point where you're going to have to watch at least into the close for today. And of course, I'll be covering this stuff in commentary, what's going on daily commentary. And as always, with the summertime blues on, we will be doing this show on Monday and Friday. As soon as, I guess, September, we're going to have to break it down again here, and we're just getting a few weeks away and getting into doing a 3-time-a-week show and bringing back Process Warriors, all kinds of fun stuff we'll do during the fall. Let's go ahead and I'm going to bring, let's see here. Before we do that, let's go look at the treasuries real quick. It's been an interesting pattern because when Mitch comes on, we'll have to see. I don't think there was any movement back in these bonds. We saw a lot of the high yield bonds get kicked out, and people seem to be bailing on that thing left and right.
Yeah.
But let's take a look here at the. Let me get rid of this chart and bring up this one, and bring up the treasury here. So this is the treasuries are now at 242. We got down to 237 last week. It's interesting because this is on a weekly basis, and I have the shorts turned on the VPM Market Mind, and it actually issued a short a bit ago here. You can see right here at 263. So it's actually been short, indicating that this is a declining interest rate environment, which is not what was supposed to happen this year, right? We're supposed to be going up, supposedly, and the Fed taper and all that. But I think some of the geopolitical risk has attracted a lot of money to the treasuries, and for the moment, it's working. I'm not sure how much more there is in the treasuries from that standpoint. We're not really seeing any downward targets, although there does appear to be. Let me just look at something here. There are targets, actually interesting. There are Fibonacci targets now for 2.27 all the way down to 2.01, so that'd be 2%. Germany hit negative rates the other day, and the Bund is trading like 103. We were looking at it the other day. I'm not sure where it's done overnight, but there's you're looking at a 10-year equal to a 10-year treasury in Germany down to 1%. It's pretty ridiculous. And meanwhile, the economy's still failing, and they're not. Low interest rates doesn't mean better economy. I think they finally figured that out. I think it was Larry Summers. I hate to quote Larry Summers, but Larry Summers actually made a comment. I think it was Larry, or maybe one of the Fed chairmen, said that we might be the growth in the America may be broken forever. I thought that was interesting. So that's
an optimistic outlook.
Yeah, isn't that nice? So, but anyway, bring Mitch back in, and we're gonna go in and we're gonna talk about what happened in the database. There doesn't appear to be a lot going on anywhere, to be honest with you. One of the charts I'm clicking on here now is still going sideways forever, which is the yen. I continue to own that thing for not sure why, but it still looks to me that thing's gonna go up. I think when it does go up, that's will be the straw that broke the camel's back. So we're gonna go ahead over to VPM here.
Let's actually stay. I was gonna say we could stay in 2.0 and take a look at the total orders first.
Okay, go ahead.
And then we'll go through that.
Mitch is going to drive here, so I'm going to let him drive, and then we'll interact. One thing before you go, Mitch, I'm going to let him talk. But one of the things that we're seeing here is I just want to mention this before we go any further, is that we dropped below a 42% number. That's a key number for me. I've watched this number for years, and we're 41.32, and when we get below that number, we typically will go all the way down to the around 26 or 22. It usually indicates there's further liquidation. It doesn't happen overnight, but we did see some new stuff come out over the weekend, so we'll let Mitch go ahead and cover this now.
All right. Well, before the broadcast, Bob and I were talking about it, and over the last 5 weeks, the net selling that we've seen has totaled 10,620 securities. So we've seen that much selling across the board. So I mean, obviously we've racked up a lot of sells over the last couple of weeks. You've probably seen quite a bit of trades in your portfolios over that time as well. Going to the all stat page is where we're going to see the total run for this week. And as you see here, you can see the weekly orders. We have on the 1.2 side, we had 132 entries. For 3.2, we had 113. That's tiny in comparison to the exits that we had again on the 1.2 side, where we had 788 exits and 432 exits on the 3.2 model. So again, another net negative movement when it comes to the database, which Bob mentioned brought us down to the 41.32% long across the board. So again, still very, very defensively postured. Most portfolios, I'll have to double check the numbers, but I believe most portfolios are somewhere in the 30 to 40% invested range, just because of all the pullback that we've seen. And that lines up pretty closely with what we're seeing on the market overview side, where you can see we're out of most of the sectors. We are invested in healthcare, services, and transportation, not teleportation. Haven't figured that one out yet. All the rest are flat, and that lines up with a lot of the portfolios that we're seeing across the board, where there are some stocks that are performing, as we'll see on the dashboard. We did actually have some buys take place, mostly on the stock side, and but when it comes to your typical broad-based indexed based portfolios like your ETF or your mutual fund portfolios, you're not seeing much traction there, except for getting out of those securities. So this week, if you see here on the scale, this may look like it's quite a bit, but the scale has actually been cropped down to 45%, just so we can get a little bit better view of it. So across the board, the most heavily invested sector is actually utilities, and that's not even quite at 45% at this point. So again, we're seeing that defensive posture across the board when it comes to sectors. This week with the selling that we had, really it was somewhere around the 3 to 4% range of liquidation across the board. And if you scroll through all the different groups, you see that there really wasn't much in the way of consistency when it comes to any sort of concentration. We just had broad-based selling. One of the exceptions to that I thought was interesting was on retail, we had some new buys come along. And I know we have some earnings release this week for some of the big name retail stores. So it'll be interesting to see how that plays out, as well as consumer sentiment going forward, just to see what type of opinion that the average consumer has on this market and where their money's going. But again, if you look across the board, we're really just seeing pretty much across the board selling. On the mutual fund side, again, really there wasn't much of anything in the ways of any new buys. If you actually look at the chart, there's only one tiny sliver of green on it, and that's in the bond space. All the rest we saw selling. And if we click on international equities, you see that's where we had the largest exit, and that really had to do with the emerging markets as well as the foreign space. I mean, this is what really caught my eye going into this weekend, is the fact that we've seen this on the domestic side as well, the small cap and the mid cap space underperforming. That's also being true on the foreign side, where we've completely gotten out of the blend foreign small and mid assets, and we barely have any exposure when it comes to the growth side. But across the board, we're just getting out of these equities when it comes to the foreign markets.
Yeah, and we did see last week where the Russell was doing a little better in some cases than others, but for the most part, it was a rebound, but it was a relative rebound, I guess is the best way to put it.
Right. Yeah, and I mean, if you just scroll down the list, you can see, we had talked about this earlier as far as the bond space. If we get down to the high yield bonds, again, we had a little bit more selling this week. We sold off another 6% of all the bond funds that we're tracking. So at this point, only 6 percentage points, or 6% of all the bonds in our database, the high yield bond funds, are even invested. So we're almost completely out of that space right now. And as you see further down, again, Not a lot of activity when it came to the U.S. equity fund space. That was pretty much done last week, but we did take a little bit more defensive stance this week as well, just further liquidation across the board on these funds.
Yeah, and you can see that the large blend and all those, the large is still hanging in there fairly good, including even in our global equity strategies. We're still seeing that SPY is long, which is interesting. Meanwhile, these other sectors, if you look at the global equity strategy, it's large, mid, and small, and the mid and small are gone, and we've also seen the international stuff. That's where the risk has been. So we've owning just one thing right now, which is continuing to hold on to the S&P. So it's kind of interesting when you watch how the configuration of these portfolios unfold. You basically own right now the only thing that's worth owning, and you've got a lot of cash, so you're protecting that, but you still have an element within that portfolio, and that's where. When do our trade impact charts get updated?
They were just updated last week, the end of last, or week before last. We're going to go ahead and pull that up as well.
Okay, yeah. So the kind of nice segue, right?
Right.
But yeah, and that's what you really want to pay attention to. Even though you have 80% in cash, you still have this component that can add value to the portfolio, and it's not about. There's some misperception that I have to have all my money working to make money, and I've seen in the past, going back in the 80s and even in the early 90s, that you could be 40% invested. If you own the right stuff, you can make a lot of money. There's always some sort of rotation going on, and there's certainly a rotation in this market going on, where the large is hanging in there. You can see with the mutual funds, the stuff that we own right now, that's clearly the case.
Yeah, so as we had mentioned, on the global equity strategy, well, first off, these trade impact charts, they're updated on a monthly basis. So this is old as of a week or so ago. But you'll notice that when it comes to the investment exposure here, we had been 100% invested not too long ago. As of the last time that this was run, we were only 60% invested. And now as of last week, we're only 20% invested. The only position that we hold in this global equity strategy for is the SPY position, that large growth position. So just like we saw on the fund side of the database, we still have fairly large concentrations. We own 60% of all the large growth funds out there. But in this particular portfolio, that is the only position that's long at. For those advisors that are using the original global equity strategy, Global Equity 1, I believe we own that position, SHI as well as EEM. I'll have to pull that up.
Yeah, that's the infamous ETFDI.
Yeah, ETFDI.
Which is actually a very solid portfolio. And when I built that many years ago, the whole concept of that build was make me money, don't lose it. So it's actually done a pretty good job of doing that and getting equity to grow. It wasn't built to beat anything, just make money, don't lose it. So that was the theory behind it. That was, I always talk to you guys about setting up your I guess your strategies and having goals and what they're about. That's what it was originally about, and it was also about having global exposure. And if you remember back in the early 2000s, that was the game, to have international exposure, and it still is to a point. Although in since 2011, there was a bumpy period, but after that, we've made plenty of money. As a matter of fact, if you look at this chart right here, EEM has made 52.71% of the profits here. It's been it's killer. It's huge. The total impact is huge on this portfolio.
And the way that we structured this trade impact chart, this is a concept we came up with. What we do is we look at the value of the account the day that the position is taken on, and then we watch that trade for the entirety of it. So we look at the reallocation cells that come around and see, all right, what was the total dollar amount of gains or losses that may have been taken on that trade, and what type of impact, how does that relate to the original value on the day that we took on the trade. So you see here, EEM, this is a great example of having that emerging market position within your portfolio. When we sold out of this position back in June of 2009, it brought in 11 percentage points of total gains. It's not that we made 11% on that one position.
I think we made like 49% on it or something.
Yeah, and we can pull that down here at the bottom. We have the full list of all the trades. So let's see if I can locate this on there. Yeah, so there you go. The total gains on this was 35.58%. But because we had such a large stake of the portfolio in that one position, it's this strategic concentration or tactical concentration. How is it that you refer to it, Bob?
Either one's fine.
Either one's
yeah.
All right. So when you look at it, this brought in 11 percentage points of total gains on this portfolio. And so that's just a way of bringing in these trades into a better context instead of just looking at it and saying, all right, this trade brought on 10% or lost 5% or whatever the case may be, looking and saying, well, what did this actually do to the overall portfolio?
Yeah, and that's the point. I think it's roughly back in 2009, I remember it's a 31% gain, and a lot of folks were nervous about putting 31% of their money into EEM, and that was the only thing we owned. I think it was a late February trade, and it seemed kind of crazy at the time. Turns out that it was the best thing that you could have done. And at that time, we were roughly 70% in cash and 30% invested on one symbol. So was that a big bet? Yeah. Was it a big bet relative to the overall equity? Yes, but the 70% had zero risk at the time. So you couldn't, a lot of times if you make a big bet like that and you have other assets that are allocated to, then you have a cumulative risk versus having no risk just at one position. Plus you had a sell discipline to boot, and it ended up to be the perfect trade as it was.
Right. Yeah, and one of the things to keep in mind, I mean, we're not always going to have 30% of the portfolio in a position like EEM. We have these two charts here, the investment histogram as well as the capital preservation chart, to show you how much of the time of the portfolio are we at various different levels of investment exposure. So, with this particular portfolio, we spent 12.5% of the entirety of this portfolio, 100% in cash. So 0% exposed to any of these positions. You can compare that to the other side of the extreme where we've spent 22.5% fully invested and 100% invested. And so we get this little U shape. It's, I guess, more of a J shape, really, when it comes to the bars on this. And what we also came up with was this capital preservation chart, which just shows you how much of the time do I have a large percent of cash on hand. And so 62% of the time we have 10% of cash on hand. 59% of the time we have 20% of cash on hand. And it continues on down the line.
Yeah, and so before we get so far down this trail we can't get out, I'm going to back us out of here. And
okay.
Was there anything else? How about weekly research? Anything else we need to go through real quick before we can move on here?
One of the things that I thought was interesting this week, we didn't have a lot of sales on the weekly research side of things. We did sell out of Israel finally, and I think we made 11% gain on that. And when you actually compare that to the globe at a glance, the particular index that we're tracking for Israel, I think, is performing double what the domestic market is.
So this is year to date, though, right?
Year to date, yes. So despite what's taken place, of the bombings and such, or the missile launches from Hamas, here we go here. Let me scroll this up. Israel year to date is up 7.33%, and last week 4.3. So not quite double, but still that's doing considerably better compared to the domestic market. So it'll be interesting to see. We've also talked a lot about the issues going on in the European markets as well as Russia, and you're seeing continued softening in their markets where they're negative year to date. And it'll be interesting. They're in Germany. They're having to pay to own bonds, and the markets there are also at a loss. So it's choosing which way you want to lose money, I guess. And I guess I'll call it good as far as my breakdown of the database for that.
Yeah, and in Germany they're down 9.73%. You can see there. The other night, 9,000 on the DAX is a pretty big number. Everybody's watching. We bounce off of that. So, but we get down to 10%. I don't know who came up with these numbers that 10% equals we're in a we're now in a downtrend or in correction mode. I think they mean there has been a correction occurred. So
Right.
we got down to that 10% number, and possibly we're going to see a lot more in these markets. We've seen this market rally for what, 5 years now. So it really is a continuation, and I've talked about this before. Maybe when we'll go back to um, the other bubble machine here, and go back to TradeStation. And one of the things I have here is this Dow Jones chart, and I think I might have touched this on Friday. So stop me, Mitch, if I'm not remembering what I did.
We did touch upon this, I think, last Monday, a week ago. I don't know if we
Yeah.
talked about it on Friday, though.
Yeah, so this graph, but I just want to bring it up because I think it's significant, and that's one of the things that the reason why I keep kind of harping on this. If you recall, I was harping on the number of 1905 for about 2 years, and we did get there. It's just some of these these things do not happen overnight, but there is a pattern here. I'm just drawing up some of the big stuff here, and I think I drew this last time.
Yep.
And we've got this, they call it a bugle formation here. You can see this move, and I just drew the arrow down. You get this big move up, but we've hit the top of this line, and typically what will happen is this thing will decline back toward this bottom of this bugle, and that's all the way to 6,000. So I don't want to sound like Harry Dent here. So, but we certainly, that's typically what happens, and that's why people like Dr. Doom and all these guys that are out there look at these patterns. But this is something, by the way, if it happened as quick as I drew it here, it looks fairly quick. That's probably about 2020. Okay, so this is a long. This is more. I've talked about this before. Maybe a generational high where we're going to see a 10, 15-year decline, and it's not going to be straight down. It probably won't look like what I just drawn it here. But this would be the next big trend. Would be a major correction. Maybe it has, like I've talked about before, everything to do with 17, maybe maybe it's 22 trillion, 25 trillion dollar deficit if you continue on the path that we're on. Right now we're continuing to more or less be operate like China, which is a state capitalism, which is I talked about this before. The tools of state capitalism is the central bank and government spending, and that's how we've managed to get things like they are. I can tell you, I don't know what they're like in your area, but this weekend was scary. I was out twice. Saturday afternoon, I was out running around doing some errands, and then on Sunday, it was like a ghost town out there, and maybe it was 106 outside. Maybe that usually doesn't stop anybody in Scottsdale, Arizona. But it was like a barren wasteland out there. There was nobody spending any money this weekend. So maybe everybody was up in the mountains. That's where they were. I doubt it, though. There's close to 4 million people hanging around here, and it was just really, really dead. I went to Fry's Electronics, and they definitely were not buying electronics. I can tell you that. There's sometimes a line there can be 40 and 50 deep just to check out, and it was one deep. So I walked up and went right there. But bottom line is, these type of charts, there's going to have to be, at some time, we all know this, that we're going to have to pay the piper, and it's just a matter of time till we get there. So anyway, enough rattling. But this is the big chart that my eye's on, and then ultimately a little wiggle on this chart is a big thing. I can spread it out a little bit so you can see this just a little better before we get off of it. But you can see this last rally. We're actually the Dow Jones. This is Dow Jones is just breaking through. It looks like. Let me bring up the number here. 16,444, 16,615. So we're just above that 10-month moving average. We're not close to it on the S&P that I looked at a minute ago, but the Dow Jones is very close to doing it. Last time we broke through it, you can see This is the decline we had. And it's interesting because after making these new highs, the typical move is back to the previous correction phase. You can see in 2009, of course, we went below that. If we were to do that, that would be back to that 6,000 number. And this was pretty quick. This was about a year. Nothing like if I went back and brought up 1987, which was 40% correction in 3.5 days. So if you didn't live through that one, you didn't live. You don't have the perspective that I do. That was a very interesting point in time. So let's go ahead and hopefully Mitch has picked out some stocks for us to look at today, and we'll finish up the last 15 minutes, and then we'll go back and see where we are on the review of before we leave the day.
All right, the first one I got on my list is Nuance. I thought they are releasing earnings today. Ticker is NUAN. And Bob, I know they're one that you're familiar with.
Yes, they are.
And right now we're currently optimized on the 3.2 trade system. And we are long this position currently. And this has been a pretty volatile stock over the years.
Let's see here if I can get a... Oh, I do have 3.2 there. Okay. Yeah, so you can see, just looking at this pattern really quickly, I'll blow this up just a little bit, expand it so we can see the bars a little better. There's a couple things just immediately that pop off. We've been in this range for a while here, and there's just above Mitchell's head there. I'll bring up the numbers here. So the targets are for about 2011. So that's about another 10-12% on the upside from a Fibonacci pattern standpoint. If we bring this thing up in BPM, let's do that. Let's bring up 2.0 real quick, and let's just take a look and see what statistically we're looking at that. Since I have a memory like a gnat, what is it? NA what?
NUAN.
Okay.
Usually I'm the one that has no memory.
I know. There we go. So I just want to see from VPM's viewpoint. You can see where we bought it here. Now we're going to look at
on the trade profile page where we have the duration. We're currently 44 days into an average 185. So we're still fairly young into this trade.
Yeah, and the expectation is for a 27% gain. It's currently a 5. And we're looking for a target price of $59.45 from.
No, the other way around. We're 59% gain. Target price would be 21.
Oh, okay, sorry about that.
No.
Yeah. So anyway, so we're looking at so we're looking at a target of 27. I was just talking about target of 20 and change from a Fibonacci, so we'd be going just above that, and a lot of dyslexia issues here today.
You haven't had enough rock stars yet, right?
Yeah, I know. So anyway, but the bottom line is saying for a standard deviation, it's huge, 160%, $44 target. That would be huge. That would be off the map here. I don't know. That's a lot of dragon sales, right?
It is.
But yeah. So anyway. Not sure. This chart's been a pretty tough one, and we've got an effectiveness rating right at good. It's a 100.34, so it's been pretty choppy. The only way I would have anything to do with this stock actually is if we had, if you were able to find this off of a screen. My bet is when it was declining here, the balance sheet wasn't looking too spiffy. So
right.
Maybe it would have shown up on a value screen, but I doubt it. I doubt it very much because it doesn't look like earnings or anything was there. I'm not sure what the fundamental backdrop is, but based on what we're seeing here, I don't expect that to be the case. So what's next?
Next up is CBS. Now they announced, I believe it was last week, that they may start working out a deal with Netflix to be able to put some of their content on some of these video on demand or video streaming services like Netflix or Hulu or Amazon. So it'll be interesting.
All they need is a good show to stream, right? Do
There
they
you
have
go.
it? I don't know what they. I don't watch.
I don't know.
any-
I haven't watched.
I don't
TV
watch
in
network
years.
TV, so I don't have any clue what they're doing. But yeah, a couple things. Currently, the VPM Market Mind has a short signal on this actually, and we have some Fibonacci targets that are down here a ways that doesn't look like it's going to be a very good deal they're putting together. Targets of let's see here, 52 men, 44 down. We're currently 59, so we're looking at 15-20% decline in the stock. Just to kind of talk about this, one of the things with this database, when we've seen, Mitch and I were talking about this, but showed 10,620 cells in what, the last 7 or 8 weeks?
5 weeks.
5 weeks. So in 5 weeks, we sold 10,620 symbols. What does that mean? It means there are a lot of trends that have failed in the pattern. So that while some of these stocks will rebound, some will decline, there's a lot of dynamics. When you're in the individual stock space like we're looking at, here's a stock we're looking at, probably got a potential 20-25% decline. You want to make sure that you're keeping up with the discipline here and not getting too not trying to be cute and override and think you know what's going on. Maybe you do, but chances are there's a lot more probabilities that these stocks are failing than they're doing. On an indice basis, you know, we may just chop sideways, maybe never see a 10% decline. We may go sideways. And the whole philosophy behind what I've done for the 35 years that I talked about is really, if there is no trend, I'd rather be having a margarita or something on the beach than taking risk. And you only want to take risk when the probabilities are slanted in your way. So you're much better off having cash around. And the unfortunate part is most of you guys are getting driven by your clients whining about how come we're not beating this or that. And the reality is just like something like the ETF DI or the Global Equity 4, and that thing's up like 37-39% in 3 years. So it's done a good job, and overall it's done even a better job when you're looking at doubling your money plus over the last 7-10 years. So that's what you want to do, and it's not about beating this stuff out. So it's kind of it's about controlling risk, number one. Capital preservation has always been number one in my book, because I want to be able to trade tomorrow. If I lose all my money, then I'm just out of business. And that's that. You know, I came from a different world than most of you and most of our customers did, from the standpoint of being a commodity trader. You know, you had to hang on to your cash and be able to show up the next day. So enough about that. But yeah, so this stock has some downside. What's next here?
Next up is LinkedIn, LNKD, also on the 3.2 system. And we are currently flat this position for the 3.2, which is the optimized one.
Yeah, and unfortunately, one of the downfalls of this particular one, there's not enough to calculate the indicators here, so I need more data, and it won't go back far enough to generate a buy or sell. But we can go over here and we'll bring up 2.0 here just so we can look at it. LNKD, right?
Yes, sir.
So I have us flat it, is that right?
Yep. Yeah, we're currently flat this position. And you can see, just like that one, if you had overridden the sell signal back in late last year, you would have experienced quite the pullback. Fortunately, the 1.2 system did catch the most recent rally pretty nicely. 3.2 is still waiting for the trends to further emerge on this.
Yeah, and this we saw this even going to Netflix. I remember back when if you have 1.2 on Netflix, you had a trade in there that had a big loss because it played that. A lot of times these things will come back and retest their lows, which was the case of, well, let's bring up 1.2 here real quick while we've got it. So you can see it bought it real nice, as you pointed out, right into that range there. I blew up you guys are going to get dizzy when I get done with you here. But I blew up this chart a little bit so you can see. But it definitely, you're looking at a nice 23% gain on this rally, where 3-2 is going to wait for the larger pattern to unfold. And 3-2 did better on this last trade. It was in and out on 1-2. So when you get down to it, you start to look at total net profit here. I don't know what it's 126 on 3-2. Let's see what that comes up with, and 81 on 1-2. Even though sometimes you'll see a trade or two, you're quite a bit. You're almost not quite, but you're about 40% better, 50% better than you are on 3-2 using 3-2, waiting for that signal. And it's not about catching every wiggle on the chart. It's about doing the right things with the money that have the longer term aspects of where the trends are.
Right.
So, okay. So, yeah. So, but from a pattern standpoint, we're not really. We don't even have any Fibonacci patterns that are being generated here. So there's nothing on the upside to really key off of here. And this stock is up, 2% today. And that's about it. So we got 4 minutes to go. We got anything quick? What do you got anything else?
How about Priceline? Priceline's
what is that, PCLN?
You got it. And I haven't looked yet to see. I know they had announced that they were going to acquire OpenTable. I don't know if that's actually taken place yet.
Oh, that's right, huh?
But we're currently flat this position.
Yeah, so I've got a long on here, and I'm not sure what I got on. Is this 1-2 or 3-2?
1-2.
Oh, okay, that's why.
Sorry. Yep.
That's okay. Yeah, 3-2 once again is long. This I've got the VPM Market Mind, which is the same as the VPM models. So the difference is this one actually has short signals in it as well. So none of the shorts have really done anything on this particular stock. There's been a couple small shorts there, but the bottom line is we do have some price objectives here. Cover quickly, so before we run out of time here. But the upward price objective here is for the high target is for. I'm looking at this number. Is that really right? 1,300. It is.
Yes, it is.
1362 to 1467 with an extreme of 1532. So these guys need to think about a split. Huh?
Yeah, I wouldn't be surprised if after the acquisition of OpenTable is complete, if they finally do break apart, because even then OpenTable is trading around, I think, $100 a share. So chances are, or maybe it was $30 a share. It is 100. I think it'll be a good opportunity to get some new blood as far as investors into these equities, because it's been a popular choice for a lot of investors, both OpenTable as well as Priceline over the years.
All right. Well, we'll complete the show here. I'll spend a couple minutes here, and we'll take a look at what's going on here. This is the 5-minute futures chart that I'm looking at right now, and this cycle, we're due for kind of a cycle low here that's going to put us in. I'm just moving this chart over a little bit so I can see probably about an hour and a half. So prior to the open, prior to the close, we should have a some sort of bottom here. Maybe we'll get a last hour rally. If it breaks through any of the key numbers that I talked about earlier, we're still hanging around that 1942.07 number. So from that standpoint, we're pretty close to completing this. And I'll go over and let's bring up a super. Matter of fact, let's go to we'll go over to the webs, and you can see the action. This is the actual E-mini trading real time, and we're looking at right here a little bit of consolidation starting to build. It looks like we're about 400 points off the highs, 300 on the futures, 3 and change, and we're starting to see some momentum changes, and there's not a lot of liquidity. And I've noticed in the last few days, maybe it's the summertime blues, that there hasn't been a lot of liquidity around the markets. Right now we got 320 bid offered by 230. Those numbers are usually 3 and 4 times out. In a normal, you're probably 800 to 1,000. And in this range here, we have traded about 25,000 contracts. But just there, we just dropped 75 cents on one tick. So I'm in front of the time the bid ask there, but you can see that there's a lot of red on the screen right now, which is selling the bid. So you can see it declining as we're talking here. So anyway, that should do the show for today, and we're going to be here on Friday. As always, if there's any big events, we'll do a impromptu call like we did a couple of weeks ago, and we'll go from there. So thanks for listening, and unless Mitchell's got something last minute, then you got anything, Mitch?
No, you brought me on for nothing. I won't delay the show anymore.
Oh, okay. Well, I always want to give him the last word, you know. So anyway.
Appreciate that.
Okay. All right, folks. Have a great day, and we shall see you on Friday.